All right, let's dive into what might be the single biggest accounting headache for pretty much any marketing agency out there. We're talking about untangling client ad spend from the money your agency actually earns. If you get this wrong, it can cause some really serious financial problems. But if you get it right, well, that's when you unlock true clarity on how healthy your agency really is.
So let's kick things off with a simple question. You send out an invoice for a nice, round $30,000. Feels pretty good hitting send on that, right? But how much of that cash is actually yours to keep? The money you use to pay your awesome team and grow the business? The answer? Well, it might just surprise you, and I can almost guarantee your accounting software has no idea what it is. Okay, so here's a typical breakdown of that invoice. You've got $25,000 that's just earmarked for the client's Facebook ads budget. That's money you're basically just holding for them. Then you've got the $5,000 agency management fee. That is for your brilliant work, your strategy, your expertise. See, we're looking at two totally different kinds of money here, all on one invoice.
And there it is. That's your answer. The actual revenue your agency earned from that entire $30,000 transaction is just $5,000. The other $25,000? It's just passing through your bank account on its way to Mark Zuckerberg.
Now here's the really crucial part. Without a very specific setup, your accounting software, something like Quickbooks, it sees that $30,000 deposit hit the bank, and it just happily books all of it as revenue. It has no way to tell the difference between your fee and the client's ad budget. And that one simple mistake, well, it leads to some very, very expensive problems. Yeah, this confusion isn't just a small bookkeeping error. It's much bigger than that. It leads to what we call the high cost of confusion, and it has some severe, real-world consequences for your agency. First up, the big one, taxes. I heard a story about a real agency that miscategorized its revenue just like this, and they ended up paying an extra $300,000 in taxes. Just think about that for a second, paying a massive tax bill on money that was never, ever yours to begin with. It's basically paying tax on phantom income. Ouch.
Or what if you're trying to get funding, or maybe even sell your agency? This mistake can be an absolute deal killer. When investors start doing their due diligence, they'll see this huge inflated revenue number and equally huge costs, making your profit margin look tiny, like a dangerous 5%. But in reality, your true margin on your actual fees might be a super healthy 25%. They're going to walk away thinking your business is broken.
And this is the one that can put you out of business almost overnight. You look at your bank account, you see a healthy balance, say $180,000. You think, awesome, we've got plenty of cash to make payroll. But what you don't realize is that $120,000 of that is client money you're obligated to spend on ads next month. Your actual working capital is only $20,000. And all of a sudden, you literally can't pay your team. It's a nightmare. This number just shows how completely distorted your books can get. A single typical invoice, when it's miscategorized, can inflate your P&L statement by a staggering 727%. Your financial reports basically become a work of fiction, which means you're making critical business decisions based on totally bad data. Okay, so that's the problem. It's big, it's scary, I get it. But the solution is actually beautifully simple, at least in concept. It's called the two-bucket system, and it is all about creating a crystal clear separation in your accounts right from the very beginning. The whole entire system really hinges on understanding this one crucial concept: pass-through funds. This is any money you collect on behalf of your client that's really just heading for a third party. Think ad platforms like Google, software tools like HubSpot, or even freelancers. It's not your money. You're just the middleman, the courier. And this slide right here really just makes it crystal clear. On the left, you've got pass-through funds. It's the client's money, you hold it temporarily, and this is key. It's a liability on your books, not taxable to you. Then on the right, agency fees. This is your money, you've earned it and you keep it. It's recorded as revenue, and yep, it's taxable. Two buckets. That's it. Simple.
So how do we actually build this inside of QuickBooks? It all comes down to your chart of accounts. Bucket 1, you're going to use liability accounts. So when a client pays you for their ad spend, the cash goes in here. Bucket 2, you use income accounts. This is where your management fees and your retainers get recorded. This structure literally forces every single dollar to be categorized correctly from the moment it comes in.
Now, setting up the accounts correctly is step 1. But if you have dozens of clients, you're still looking at a mountain of manual data entry. And this is where we make the leap from a solid manual process to a truly efficient, automated workflow.
Let's just put some numbers on that manual pain, shall we? An agency with just 20 clients creates something like 1,440 individual invoice line items every single year. Each one of those needs to be read, understood, and then manually assigned to the right bucket, revenue or liability. It's so tedious, and the potential for mistakes is huge.
And here is the payoff of automation. Manually, this whole reconciliation process can take up to 40 hours a month, a full work week. With an automated process, that time just collapses to maybe a couple of hours. And most of that is just for a final review. That is a massive, massive win.
So the automated workflow itself is actually pretty straightforward. A script connects to your QuickBooks and pulls out any new invoices. Then it sends the line items over to an AI, like Claude, which has been trained to know the difference between a management fee and ad spend. The AI zips back the correct classifications, the script updates QuickBooks automatically, and boom, it generates a clean report for you. And you know, this is why it works so incredibly well. The AI isn't just matching keywords, it actually understands context. For example, it might say something like this. Line 4 is a pass-through because the description says HubSpot subscription allocation. It recognizes allocation as a common pattern for these pass-through costs. That kind of reasoning builds trust and makes the final review process incredibly fast.
The impact here is a 93% reduction in time spent on this manual, error-prone reconciliation. We're not talking about a minor improvement. This is a fundamental change in how your agency's back office can operate. It frees up your absolute most valuable resource, your team's time. And this really brings us to our final thought. The agency in the case study, they saved 28 hours a month. The owner used that time for sales and ended up landing 3 brand new clients. So the real question for you is, what would you do with that time? Develop a new service, spend more time on client strategy, or maybe, just maybe, take a well-deserved break. That's the power of getting this one critical process right.